Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, asset allocation. You've often heard on this show itself, a lot of experts talk about how important it is to diversify our investments across different asset classes. So it's very important not to be squarely focused on any one, equities or gold or fixed income. This is where hybrid funds come in. And within the hybrid category, one category called the multi-asset allocation fund category, this has been garnering a lot of investor attention. In fact, the flows into this category have been going up, and we'll put up some of the data points that highlight that. At a time when mid-cap and small-cap funds, traditional equity funds, they've been getting lesser flows, and I'm talking about the latest numbers which came in from the industry body AMFI. At a time when regular equity funds have seen slight dwindling in flows, this category, the multi-asset allocation category, has been quite steady. As you can see out there, flows have been averaging anywhere between 5,000 to 6,000 crores on a monthly basis. So what's behind this trend? Is it sustainable? And is this fund category really an important one when it comes to us and our journey of wealth creation? That's what we're going to discuss with our Sivakumar, Head of Products and Corporate Strategy at Axis Mutual Fund. Sivakumar, thank you so much for joining in. It's a pleasure to have you, especially personally, now that you've taken the trip and you've come to our studio. So thank you so much.
Thank you. Thank you for having me.
So, Sivakumar, this is an interesting topic because in your earlier avatar with Axis Mutual Fund, I mean, you're a veteran of the fixed income market anyway. Now you're overseeing a lot of other categories as well. So just walk us through what you've made of the investor psyche and shifting investment trends as we've gone through a year of low returns to almost no returns in the equity category.
Yeah, it's a good place to start. I think equities have had a great run, and I think equity mutual funds have continued to see inflows despite, as you rightly said, well, not poor performance, but I think consolidating performance, I will say, for the past year or so. It's interesting that flows have continued to be at a steady clip, maybe slightly off from the peaks in terms of net inflows into that category. One of the interesting things that we've seen, especially over the last six years or so, post-COVID, is that investors have continued things like SIPs even when there is market volatility, which was not the case before. Every time the market would slip, you would see SIP cancellations and redemptions because people would, get frightful. This is the first cycle where we have seen kind of an equity culture, if I may say so, getting built, wherein people are staying invested and adding to their investments, even if the market returns, near-term market returns are not very strong. So I think that's the first and most important thing that you can see in terms of investor psyche, let's say over the last few years that we have observed.
Okay, so that's what's happened so far. And then, I mean, tying in with that, and we always talk about it when the mutual fund numbers come out and everybody's looking at the net equity number, and sometimes it's lower and it's come down a lot from 40,000 crores per month to about 25,000 odd. But since I do this show and I look at personal finance, I see it as a sign of maturity, because simultaneously flows into hybrid funds and to this particular category, multi-asset category, they have started going up.
Yes.
So would you say that the lesson of asset allocation, that's finally getting learned? Is it getting learned well? And then, how do we look at some of these hybrid categories when it comes to asset allocation?
Yeah, it's a great question. And I think you're absolutely right. Multi-assets flows have remained strong through this entire cycle. Yeah. So one could argue, why is it if equities are done so well, why is it that people are investing in multi-asset and so on? I think a couple of key factors drive it. One is the relative stability. So when you look at long-term returns from multi-asset as a category versus equities as a category, returns are in the same ballpark, very close to each other. There are some really long periods of time when multi-asset has outperformed equity even, but at a much lower level of risk. And so the first thing is multi-asset as a category, I think, has proven itself. And this is not an India story. This is a global story. Across many markets, you have seen this data that multi-asset as a category has delivered similar return to equity, but at a much lower risk. The second thing that has happened, I think, is the tax change on fixed income funds, which happened a few years ago, and therefore the drop-off of fixed income allocation.
Yeah. And
people have chosen to invest in multi-asset and other hybrid categories as a proxy for debt, meaning to also get some debt exposure. I mean, that's one of the important drivers of flows into hybrid as a category as compared to traditional fixed income as a category. So I think that's something which again multi-asset as a category has managed to capture. That is to say, you get an exposure to fixed income and gold and equity at the same time, and you get a much more tax-advantaged way of playing those three assets together.
That's a very important graphic on our screen right now, and let's just explain that to our viewers. What you're seeing is basically how asset classes perform across different market cycles. And there is never a fixed rule. You can never wake up on the 1st of January and say, this is the asset class that's going to be the winner of the year. Because in this data, we've taken 3 different buckets, 5-year buckets. And you can see in the first bucket, immediately after the global financial crisis, which is 2008 to 2013, equities weren't doing that well. The Nifty 500 is actually down. The 10-year G-Sec yield, basically fixed income was a better performing asset class, 9%, and gold, because we were in a risk-off environment, gold did really well. Come to the next 5-year bucket, 14 to 19, again, the returns are varying. Equity and gold somewhere around the 7 to 8% handle, fixed income 9%. And then the real equity bull market actually took off just after COVID, which is about 17, 18% equity return, fixed income 6.5%, but gold did well even in this period. Now, who's to say, at least I cannot extrapolate the next 5 years and fill the 4th column of that table. But that's the thing. So, Sivakumar, let's address this. Asset allocation. For a lot of investors, they equate asset allocation to chasing kaun sa asset class acha karega. Now, gold did well, so let's put some in gold. And, maybe equities did really well, so let's go full hog on equities. How do we break out of that psyche?
It's important that you break up asset allocation into 2 parts, what's called strategic asset allocation and tactical asset allocation. Strategic asset allocation has got everything to do with your return risk profile, and when you look at studies which say asset allocation explains all the returns of a portfolio, etc., those studies are based on strategic asset allocation, meaning how much you allocate to the different assets you own substantially explains the returns rather than individual stocks or bonds. It's really how much you allocate which matters a lot when it comes to long-term performance. That's the first part, right? Once you've agreed on a strategic asset allocation, let's say the classic portfolio 60-40, 60% equity, 40% fixed income. And these days, that's up for debate. Does that 60 become 61 or 65, or does it become 55? So how do you, at the margin, make that allocation decision on a year-on-year basis, or even on a 5-year cycle, as your data just showed, that for 5 years you can have different assets perform differently, right? That's where tactical asset allocation comes into play. So tactical asset allocation is about trying to play shorter term cycles, from a few months to a few years, where you take a call on which asset class should be overweighting or underweighting. And I think that's where these multi-asset funds which take asset allocation calls come into play. See, as an asset manager, I cannot create every strategic asset allocation there is. Some investor may be close to 0% equity and some are 100% equity. Can I create products at every mix? Not possible. But we can create products which take these tactical calls.
That's a very important and very interesting thing you said. So first of all, it's okay to take tactical market-related calls with respect to asset allocation. It's not like against the cardinal rules of financial planning. There is the overall asset allocation that you should have depending on the nature of investor that you are. I mean, are you a risk-averse investor or etc. But there is a tactical element to it. And that's where these multi-asset funds fit in.
Correct. And you can do this by having multi-asset funds which buy directly into stocks and bonds and gold, etc. But you can also do through a fund of funds route wherein you're investing across, let's say, equity mutual funds, debt mutual funds, gold ETFs, and so on and so forth. So I think the way to play this is multiple ways. If you're, for example, owning a multi-asset fund in the traditional way, which owns stocks and bonds directly, then it's more of a bottom-up picking of stocks, and with, of course, macro and other overlaid. But you can also do a fund of funds approach where you're doing a lot of top-down, right? Trying to figure out top-down, what's the right allocation to have, and then trying to find which funds, which strategies. Do you want to go into thematic or sector funds? Do you want to buy flagship equity funds? Do you want to similarly do on the credit side or a duration side, etc.? So that becomes an interesting way to have 2 or more approaches to tactical asset allocation.
Okay, so that's lesson number 1 that we've learned, that multi-asset funds could be an interesting way of blending more asset classes in a smart way into your portfolio, because we may not know all markets. We do not know which asset class could perform which way. There are, fund managers who have better visibility in all this and are more equipped at taking those calls. Now, Sivakumar, again, lesson number 2 is just understanding what these multi-asset funds look like, what is their structure. So I believe they have to invest in a minimum of 3 asset classes, right?
Correct.
And is there a minimum threshold, holdings? What is their overall, and what is the regulatory framework?
The regulatory framework is, yes, minimum 3, and the minimum within. So for example, if you have equities, that has to be minimum 10%. If you have commodities, that has to be minimum 10%. So from a regulatory perspective, to qualify as a multi-asset fund, you need to have minimum 3 asset classes, and each of them have to be meaningful. You cannot have
10%
1 or 2% in an asset class and call that a multi-asset fund. Right? So the idea is to have some meaningful allocation, and the regulatory minimum is 10%. So most of the funds in the industry have gone with equity, fixed income, and gold, or commodities in general, gold, silver, and other commodities, as a way to satisfy this need. And I think that's probably the right approach. You could add global stocks, for example, as another asset class in this. I don't think anyone's really doing it. And in the current situation, of course,
there are limits on the global exposure that you can take.
And that creates its own challenges. So therefore, today, that may or may not be the right way to do it, but at least you can have minimum of 3, minimum of 10% in each. Whether you do that through direct investments or through a mutual fund, it's fine. But the idea is to have at least 10%. That's something meaningful. The second consideration that comes into play here is, of course, taxation. As we discussed, on debt, taxation is quite punitive in the sense you get marginal tax. Whereas if you do a fund of funds, or if you do a 65% plus equity or a 35% plus non-fixed income, then you get long-term capital gains tax, which is way more beneficial to investors. So that's the other consideration that fund managers have. That in theory, you could have a multi-asset fund which is 80% debt and 10% equity and gold, but it doesn't make sense because it's far more tax inefficient. So you would want to be equity heavy, or you would want to be at least reasonably balanced.
But that's also an interesting dilemma, perhaps, that it raises in itself, taxation.
Yes.
Because like you explained, that if first of all, there is no standard taxation rule for multi-asset funds. Please be very clear and make sure you keep asking your advisors about this, because the way a multi-asset fund will get taxed will depend on the amount of equity it's holding. If it is holding more than 65% of its assets in equity, only then does it get the advantage of equity taxation, which means that after 1 year, you pay long-term capital gains tax at 12.5%. So that's the most favorable taxation from our perspective, from the investor perspective. But that also raises a question, and just tell us what you see across industry. In order to be tax effective, if most multi-asset funds are anyway loading up on 65% equity, then are they really being true to their mandate, which is offering a great balanced multi-asset portfolio?
Yeah, so there are two choices. One is about 65% equity to qualify for the 1 year long-term capital gains tax. The other is to be above 35% in non-debt. So up to 65% in debt, but not crossing that 65 threshold, which means you get long-term capital gains after 2 years, but the same rate. So, which essentially, 2 years is nothing for a asset allocation investor, right? So I think for investors who have beyond 2 years, you do have a greater choice of these multi-asset type of products, because you can do pure equity or equity biased, or you can have a more balanced portfolio. So both options are on the table. I think we take too short a view sometimes, and we believe that 1 year is important, but 1 year is not important from your investment life cycle, right? You are investing maybe for 5 years, 10 years or more, and so it makes sense to look at these funds from a longer term perspective rather than from a 1 year perspective.
Okay, all right. So now we've learned the basics of this category, the multi-asset allocation category. We'll come back, talk about reasonable return expectations from this category, and also figure out what are the kind of funds. How do you choose the right fund? How do you blend it with the rest of your portfolio? That and more after the break.